Every single profitable trader out there knows how to read the markets from top to bottom. You need to be able to understand the markets starting from the higher time frame perspective, such as the weekly, the daily, and the 4-hour. And then after that, you can zoom in all the way down to the 30-minute, 15-minute, and 5-minute to get the best possible entries. You see, one of the biggest mistakes new traders make is that they get lost in the noise of the smaller time frames, and by doing that, they completely forget the bigger picture. But when you step back and understand the bigger picture, everything else starts to make sense. You'll know what the market trend is, when it's likely to reverse, and where the real trade setups are. So without further ado, let's jump into this video and let me explain what top-down analysis really is and how you can implement it in your own trading. So funny enough, I already recorded this video outside, right? I didn't get inside, and I just look at the recordings back, right? And I just see that everything is laggy. My computer's overheating like crazy because it's 30 degrees outside, but I didn't think of it, right? But it doesn't matter. I'm just gonna do the video again. But anyways, let's start off. So what is a top-down analysis and why does it matter? Well, a top-down analysis is just when you zoom out to get a broad view of the market. So you zoom out to identify the overall direction and to identify the overall trend. And then later down the line in the down section thing right here, you then zoom into the smaller time frames to get the best possible entries, right? So if you do a top-down analysis, you start off with the monthly, then you go down to the weekly, daily, and 4-hour. These 4 time frames right here figures out the overall direction and trend. And then later down the line, I'll get into it later in this video, you can use the 1 hour, 30-minute, 15, and 5-minute to get the best possible entries and to get the best possible exits, right? So by using the higher time frames, you figure out where the key levels are, what the overall direction is, and just where price is most likely gonna reverse and reject, right? And why does it matter? Well, because higher time frames always has more power than the lower time frames. One weekly candle has way more power than a 5-minute candle. That's just logic, right? So before we get into how to take advantage of lower time frames for entries and exits, well, let's compare the lower time frames to the higher time frame. So I've drawn out the 4-hour price action and the 5-minute price action. And remember that this is literally the same price action, just on 2 different time frames, right? So just tell me off the bat, which time frame looks the easiest to read? Which time frame looks the cleanest? Well, it's obviously these 4-hour candles right here. It's the 4-hour price action. Why? Because there's only 3 candles. That's it. 3 candles versus 36 5-minute candles. That's literally it. That's what I'm saying about most new traders get stuck in this. They get stuck and lost in the lower time frames and they completely forget the higher time frames. Because on the higher time frames, it's literally just a break, retest, continuation, or a break and retest, or you could call it continuation, consolidation, liquidity, continuation. That's literally it. But on the smaller time frames, traders get in right here because they see that, okay, well, this area gets rejected right here. This area gets rejected. Let's go take some sells for price to continue down. But they completely forget that this 4-hour candle literally just closed bullish inside this range. And the next candle is just grabbing liquidity, right? So they get ran right here, right? So the first position got ran because they thought that this was sells. Well, we obviously in a bullish direction, right? So they completely forget the bigger picture. Then they end up taking buys right here because now they think that, okay, well, this level on the 5-minute is getting respected. So let's take buys for continuation to the upside. Well, they get ran, their stops get ran, they get liquidated because they thought that this was the key level, the 5-minute, but they completely forget that this down here is the overall higher time frames key level and price most likely will grab liquidity before going in the overall direction. So this is what I'm saying about the new traders getting stuck in this whole move. This whole move is just noise. Literally just zoom out to the higher time frames. Zoom out, look at the overall direction, which in this case is bullish. Look where key levels are and everything will be way easier and everything will become more profitable. So now that we went over what a top-down analysis is, plus we've also compared the lower time frames versus the higher time frames to see which one is the easiest and cleanest to read, and how retail traders, how new traders get stuck and distracted by lower time frames. So here we are. How do we take advantage of lower time frames to get the best possible entries? Well, very simple. So instead of getting distracted by the lower time frames, we start off with the 4-hour. I've also the daily is bearish. I can also see this just by looking at this. So the daily is bearish, the 4-hour is bearish, right? Very simple. It's literally just this. So let's drop down to a bit smaller time frames. Let's drop down to the 1 hour. Let's see how it looks. Yeah, drop down to the 30-minute, right? But before we do that, we can see that this is a key level. This right here is a key level. There's a key level up here. Remember that. So let's draw it out actually. So obviously this is in hindsight, right? And I'm just looking at rebuild bars on TradingView. I could just say whatever I want to basically, but I did take this trade. I'm pretty sure it's on YouTube as well, the breakdown. So anyways, yeah, levels here, levels here. This is key levels on the higher time frames, right? So we don't forget that, right? So very clean. There's a level here, and down here. So let's go to the 30-minute right here. Yep, very simple. What does price do? Well, it pushed down first. It's starting to consolidate, and it's starting to push down now. What retail traders, what beginners think is that, okay, maybe they take sells right here, stops above, targeting these new levels. Well, it looks pretty good, but there's no liquidity. So this 4-hour candle right here, let's draw out the previous high here, right? Because there's liquidity up there. We want to see that get ran before we get entries. So all the retail traders get liquidated and then we get entries, right? So let's fast forward some candles. We get activated, boom. We get activated here, price then pushes up, grabs all this liquidity. Look at this, above previous high right here, and then flips bearish. That's literally it. That's so easy to read. But look at this, retail traders got stuck here, they get liquidated, right? But instead of getting in early and getting in sells early, we just simply wait for the liquidity grab, then take advantage of it later on. It's literally that simple, and it also tapped this key level down here. Easy to read, right? Let's go to the 5-minute. Let's see what new traders would have gotten into. Let's go down. Let's go back first. So they would probably see that this right here looks pretty good for buys, right? With the stops below, and they are probably targeting way up here, right? But they don't know that the overall direction is bearish, so they're taking buys counter trend, right? Plus there's a key level right here, right? Plus that this is just this level right here is the liquidity for the previous 4. So let's fast forward. Let's see what happens to retail traders. Boom, liquidated, just like that. And then boom, next candle. So easy, just follow, literally zoom out to the daily 4-hour and figure out what the overall direction is, and only take trends or only take trades pro trend, right? So take sells in this position, just wait for liquidity, wait for the retail traders, wait for the new traders to get liquidated, to get stop hunted, then follow the overall direction down. That's literally it. That's how you use top-down analysis to your advantage. So that's literally it for this video. Hope you enjoyed, and I will see you guys in the next one.